At the exact moment Brent crude crossed the 10% spike threshold overnight, something happened that the anchors on every major financial network refused to say out loud. They showed you the flames. They showed you the map. They gave you the geopolitical theater. What they did not show you is the ledger that was already on fire before the first refinery went dark. Subscribe to this channel immediately, because what I am about to walk you through is not the political theater you see on mainstream media. This is the exact mechanism of how the system is breaking. Turn on notifications. Set them to all, because the next 48 hours will redefine the markets. Here is what is confirmed and verified right now. Saudi Aramco's refinery production has been severely impacted by military escalation in the Middle East, cutting 500,000 barrels per day from global supply. Simultaneously, Qatar Energy has temporarily halted liquefied natural gas production. European gas prices have surged between 40 and 50% as a direct result. Brent crude is up over 10%. And the Federal Reserve right now, today, is holding interest rates at their current elevated levels with no indication of a cut. These are not projections. These are operational facts on the ground. Now, let me give you the quote that the system does not want you to contextualize. Quote, "The energy price shock is an unpredictable byproduct of foreign conflict. The Federal Reserve and the U.S. Treasury are victims of global circumstance, bravely holding interest rates steady to fight this imported inflation while trying to protect the U.S. consumer from geopolitical fallout." That is the official narrative. That is what you are being sold, and I am going to dismantle it with math, with verified data, and with the one question they are praying you never ask. If the Fed was already failing to bring inflation under control before a single shot was fired in the Middle East, how can the war be the cause? Let us start with what the data was already showing before this escalation. PCE inflation, the Federal Reserve's own preferred measurement, was already sticky and above target before the energy shock hit. That is not my editorial. That is not conjecture. That is the official economic data confirming that the Fed's rate policy was already failing to accomplish its stated mission. 4.4% PCE. Inflation was not moving toward the 2% target on its own trajectory. The policy was not working. The mechanism was broken. The war did not break it. The war arrived after it was already broken. That sequencing is everything. That sequencing is the entire story. Now layer in the bond market. Treasury auction yields are currently at crisis levels. The United States government requires an extraordinary volume of debt buyers at every single auction cycle to fund its existing obligations. When yields are this elevated, the carrying cost of that sovereign debt becomes mathematically punishing. Every basis point increase in the yield on 10-year treasuries translates into billions of additional dollars in annual interest payments on a debt load that is already in the tens of trillions. The Federal Reserve cannot cut rates in this environment without triggering a bond market sell-off of historic proportions, because cutting rates signals that the central bank is prioritizing growth over inflation discipline, which rational bondholders would interpret as acceptance of long-term inflationary erosion of their principal. The institutional money moves to the exit. Yields spike further. The government's borrowing costs explode. But the Fed also cannot hold rates high indefinitely without crushing the private economy. Corporate debt refinancing at current rates is strangling balance sheets. Regional banks are sitting on unrealized losses in their held-to-maturity portfolios. The residential mortgage market is functionally frozen for a generation of buyers priced out by rates that are incompatible with the asset valuations the system built during the zero-rate era. The Fed is not holding rates high because it is working. It is holding rates high because both exits are blocked. They are trapped. And they were trapped before the Aramco production cut took a single barrel offline. This is the mechanism. The sovereign debt trap was already operational. The inflationary pressure was already baked in. The monetary policy was already failing. What the escalation in the Middle East has provided is not a cause. It has provided an alibi. Think about what a verified, documented, internationally observable supply shock does to the political and financial narrative. It gives every central banker, every Treasury official, every administration spokesperson a single sentence that ends all accountability. This was caused by the war. IDC supply chain reports and COFACE analysis confirm the intentional production halts in both Saudi Arabia and Qatar. Those are real. The 500,000 barrel per day reduction from Aramco is real. The 40 to 50% surge in European gas prices is real. No fabrication required. The shock is genuine. What is manufactured is the causal story being built around it, the story that places this shock as the origin point of the inflationary wave, rather than as accelerant poured onto a fire that was already burning. Let me walk you through the mechanical chain so you can see exactly how this transfers from a refinery in the Gulf to your grocery bill and your mortgage payment. A 10% spike in Brent crude is not an oil story. It is a transportation story within 72 hours. Diesel fuel prices move with Brent. Every truck on every American interstate runs on diesel. The producer price index for transportation services begins moving within days of a sustained crude spike of this magnitude. That PPI increase gets passed directly into the cost of every physical good that moves through a supply chain, which is every physical good that exists. Before the shock even reaches the consumer price index, it is already embedded in the input costs of the corporate sector. Margins compress. Companies with pricing power pass it through. Companies without pricing power absorb it and begin cutting headcount or capital expenditure. Both outcomes are recessionary in the medium term. Both outcomes damage the household balance sheet. The bond market watches this and recalibrates its inflation expectations upward, which puts additional pressure on yields, which loops back into the sovereign debt crisis we began with. Now add the LNG dimension. A 40 to 50% surge in European gas prices is not a European problem in a globalized energy market. European industrial production costs spike. European manufacturers become less competitive. European sovereign governments face political pressure to subsidize household energy costs, which means more government borrowing, which means more sovereign debt issuance, which competes with U.S. treasuries for the same pool of global capital. The marginal buyer of U.S. government debt has fewer dollars to allocate when European governments are simultaneously flooding the market with their own issuance. This is not theoretical. This is the documented mechanism by which regional energy shocks become global capital allocation crises. For the average household, this chain terminates in a specific and brutal place. Fuel costs rise directly and immediately. Grocery prices follow within weeks as transportation PPI bleeds into retail food margins. Home heating costs rise. And the Federal Reserve, boxed in by the sovereign debt trap, cannot cut rates to provide relief, because doing so would accelerate the bond market deterioration and signal surrender on the inflation fight it was already losing. The middle-class household is being compressed from both directions simultaneously. Higher costs of living driven by the energy shock, and no monetary relief available because the debt structure of the government prevents the central bank from providing it. That compression is not an accident of war. That compression is the predictable, documented, mechanically inevitable outcome of a decade of monetary policy that inflated asset values, concentrated wealth upward, and left the sovereign balance sheet with no room to maneuver when a real shock arrived. Now, I want to take you back 50 years, because this specific configuration has a historical parallel that the financial media will not draw for you. And understanding the mechanical differences between then and now is critical to understanding why this moment is more dangerous. The 1970s energy crisis produced two major oil shocks in 1973 and 1979 that drove inflation into double digits and forced the Federal Reserve under Paul Volcker to raise the federal funds rate to nearly 20% by 1981. That policy was brutal. It triggered a severe recession. Unemployment climbed above 10%, but it worked. And here's why it worked then and why that precise remedy is not available now. In 1980, total U.S. federal debt as a percentage of GDP was approximately 32%. The government had fiscal room. The debt servicing costs, even at dramatically elevated interest rates, were manageable relative to the size of the economy. Volcker could use the interest rate tool with maximum aggression because the sovereign balance sheet could absorb the cost of that aggression. Today, federal debt is measured in the tens of trillions of dollars. The debt-to-GDP ratio is structurally incompatible with a Volcker-style rate shock. The government cannot pay 20% interest on its current debt load. The math does not close. The Treasury auction market would face a buyer strike before rates reached anywhere near that level. This is the specific mechanical difference that makes the current configuration categorically more dangerous than the 1970s parallel. Then, the Fed had a weapon and the room to use it. Now, the weapon is real, but the room is gone. The sovereign debt structure has consumed the operational space that monetary policy requires to function. And the incoming energy shock is arriving into that constrained environment with full force. Now, let me give you two scenarios. Both are grounded in the verified data and the economic mechanisms I have just mapped. Scenario one is the controlled demolition. In this scenario, the Federal Reserve holds rates at current levels through the next 2 to 3 quarters, allowing the energy shock to drive headline CPI materially higher. The administration and the Fed both attribute the inflation surge entirely to the Middle East conflict, successfully containing the political narrative. The inflationary wave does the work that the sovereign debt situation requires. It erodes the real value of the outstanding debt over time, transferring purchasing power from creditors and fixed income holders to the sovereign borrower. Corporate earnings are compressed, but large cap companies with global pricing power and commodity exposure actually benefit. The S&P holds or rises nominally, even as its real purchasing power value declines. The middle-class household sees its wages lag inflation by 2 to 3 percentage points annually for several years. No single dramatic crash, no official crisis declaration. Just a slow, systematic, grinding destruction of real household wealth conducted under the cover of a foreign war. This is the scenario the system is designed to produce. This is what a soft landing actually means when the balance sheet is this compromised. Scenario two is the uncontrolled cascade. The energy shock proves more persistent than the controlled demolition model requires. LNG production in Qatar remains suspended longer than expected. Aramco's production disruption deepens rather than resolves. European energy prices do not retreat. Headline inflation in the United States moves above 6% and begins to re-accelerate. Bond market participants, watching PCE remain above 4% and now accelerating, begin to demand meaningfully higher yields at Treasury auctions to compensate for the inflation risk. Auction participation rates decline, the Treasury is forced to issue at higher yields to clear the market, the carry cost of sovereign debt increases by hundreds of billions of dollars annually. The Federal Reserve faces a direct conflict between its inflation mandate and the functional solvency of the government it serves. In that conflict, one of two things happens. The Fed blinks, cuts rates to suppress yields, and reignites asset markets, fully abandoning the inflation fight and triggering a currency crisis in the dollar. Or the Fed holds. The bond market continues to deteriorate. Regional bank balance sheets begin to crack again under the weight of their held-to-maturity losses. And the financial system enters a credit contraction that is deflationary in asset prices, but simultaneously inflationary in essential goods, because the supply shock driving energy costs is independent of credit condition. Stagflation, not the mild 1970s variety. A version constrained by a debt structure that eliminates the primary tool for fighting it. What I know for certain right now: Saudi Aramco's refinery production has been cut by 500,000 barrels per day due to verified military escalation in the Middle East. Qatar Energy has halted LNG production, driving European gas prices up between 40 and 50%. Brent crude has spiked by over 10%. PCE inflation was already sticky and above the Federal Reserve's 2% target before this energy shock arrived, confirming the Fed's policy was already failing prior to the geopolitical escalation. Treasury auction yields are at crisis levels, confirming that the sovereign debt structure requires an inflationary environment to prevent a debt servicing crisis. The Federal Reserve has paused rate cuts and is maintaining high interest rates with no clear path to normalization. The official narrative attributes the coming inflationary wave entirely to the foreign conflict, while the verified data shows the monetary policy failure was already in place before the first barrel was taken offline. Stay with this channel, turn on notifications. When the markets open, you will see the analysis here immediately. This is not over. This is the moment when the alibi and the crime scene are the same event, and the people holding the ledger are the same people writing the headline.